Okay. The 20th of November. Welcome to This and That. Uh, New article by Michael Roberts. I think every couple of weeks, I guess we're going to do Michael Roberts. I'm not going to read it word for word. Well, maybe I will. We'll lapse into this. I think the important thing is to remember how private equity operates. Not that we really knew that at the beginning, but I think it's worth thinking about. That there are general partners, limited partners, private equity firms, a private equity fund. Uh, there are capital investments. And what's interesting is that some people don't carry all the risk. And then there's the carrying the interest. There's certain elements built into it that operate not unlike what Marx is talking about. And it's nice that Michael Roberts does this from a Marxist point of view. Doesn't give us any ideology, but certainly tells us that there's turnover, there's carried interest, there is the acquisition of target companies that were sort of built up and then destroyed ultimately. So it overlaps other kinds of things, particularly in manipulation of stuff like debt, debt service. Um, and this is all of the elements that gave us 2007 to 2008. Now, we might ask ourselves, why is Wall Street, or why are the capitalists still doing this? Well, they're doing this because it ultimately still makes money. Now, the point that Roberts makes is that it's really not that much more profitable, but I think, and with all due respect to fictionalized, fictitious capital, it's very exciting. I mean, I think that's the deal with various themes or topics in uh, fictional or quasi-fictional or whatever programs that are on our media that Big Short at all, Wall Street, Wolf of Wall Street, that show you various aspects of how vulture capitalism operates. And, it's very exciting for some folks. I think that's the attraction to it. And there's an entire generation that thinks that they can, you know, parlay this into a large that everyone can get rich. It has a kind of libertarian view of its own success. When in fact, as Michael Roberts shows, that it's really not that profitable. But I think it must be, with all due respect, fun. It does show, particularly as we've seen with Michael Hudson's work, the integration or overlap of various elements. The legal side of it, when we're talking about code of capital, you can't get a lot of these things done, particularly in an international sense, unless you have a London branch or whatever. And the tentacles of this monster are quite broad or wide or whatever. Now, the point, of course, is that you don't see any workers here. Well, I mean, there are workers. That's, people do work in Wall Street. But the fact is there's not a lot of what we would consider the labor theory of value at work. And because it doesn't have that, it retains a kind of illusion, right? And a class illusion, which I think is sort of Roberts's point as well. So, and that's kind of what's going on. It's why Blackstone is in Ukraine. They've made a deal already. It's already there. They're going to be, whatever's going to be left, they're going to be working with the Ukrainian economy. So there will be. It's not going to turn socialist anytime soon. Um, Not that we wanted to do that necessarily, but at least it, meet the new oligarchs, same as the old oligarchs. And so I included a couple of other things as I was fiddling around. Um, I included a thing from the a libertarian site talking about how, that labor theory of value is not relevant because, it's really about capitalists. You get, as long as you're consuming, you're getting stuff. It really doesn't matter. Capital doesn't exploit labor. Instead, it enhances labor's value by giving labor the tools it needs to make even more of the things that humans value. So, it indulges what Marx considered either underconsumption or overproduction, which is the road to crisis. Now, whether crisis really does occur, well, that's kind of the interesting thing about capitalism. It creates ever more tools, not necessarily for the general public, but rather certain classes. And you privilege the market. You make exchange and market prices are how we make our subjective perceptions of value accessible to others, so they can figure out how best to provide us with the things we value most. And all that, there's a certain cheerleading that goes on, and with economic development, that's kind of important. So you've got to have that sense of optimism, I think, about that. On the other hand, as you can see, the difference between lesser developed and advanced capitalist economies, you can see the disparity or the inequality of these matters and the increasing inequality of capital. And of course, this little article is about we're still haunted by the labor theory of value. Well, they keep trying to kill it off. It's not going to get killed off because there actually are people who work, and I mean, who really work. And we could say, I'm not going to necessarily sell that argument, but that the failure in the last election was, as the current meme or trope is, that the working class wasn't fully addressed. Well, if you survey the average American, people in the upper middle class think they're working class, and they're quite firm in that belief. And it has kind of always, sort of polled that way. And so you can see that the messaging wasn't quite there. The critique, of course, is that, well, there are too many college educated people, and that's what they were pitching it to. And you sort of, this is the silent majority Nixonian argument that there are people out there who are not being heard from, blah, 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 blah. Well, it's horseshit because, essentially what we now see at the end of we're getting close to now a full accounting of votes, and apparently Trump is at the popular vote is less than 50%. So any claims that there's a landslide or a mandate or blah, blah, blah. Now, it may appear to be a landslide in terms of electoral college votes, but when you see that the net was only about 6 vote or 10 electoral votes from the last time Trump won, it's really not that much of a victory. And that the vote margin in the swing states is down to something like 237,000 votes. I mean, among 7 states, you can see how only an incremental change in certain places. And that's the Republican theory of the matter, is to always focus on reinforcing the vote and doing turnout, as it were, in specific districts in order to maximize the vote and hence win the state. And that map is worth analyzing, and why the Democrats didn't learn from it the last damn time they tried it in 2020. Well, I assume they thought, well, they failed, they're going to give up. Well, they didn't give up. They did the same damn thing, essentially, and then they forced certain margins to vote to swing votes. And this is not a conspiracy theory necessarily, but does seem clear that if you only alter, a certain number of votes in certain places, and as Trump bragged, well, we have all the votes. We have the votes we need. We don't need any more votes. We don't need to send people out, even though, Musk claimed that he spent a lot of money. And we saw that there were failures in that. Essentially, it was another scam, well, sign up to go knock on doors. Well, there's there are a couple of interesting stories related to how that operation operated. But anyway, so it is a propaganda exercise in one sense, and I hope that people will make further analyses of how Republicans aren't that innovative. They just like repeating the same crap, and sometimes they just keep doing it. And in this case, all it took was a little more leverage. You know, they're eating pets. I mean, that alone should have sunk them. But because there's that, college educated meme again that, you know, it's a much more complicated story and really problematic and stupid how Americans essentially were, fooled again, and we're now paying for it. Anyway, so in my little rambling here, and I'll get to the point of all of this. I looked up, I started thinking about kulaks and how kulak oppression, clearly an oppression based on property and ownership, was executed not by Lenin but by Stalin. This is, I'm not that I'm being an apologist for Lenin, because it's pretty clear that a lot of Mensheviks got purged earlier on, but the kulaks were wealthy Soviet peasants. And so they're kind of treated as a class enemy of one kind or another, and they were given various options. They could be completely wiped out, including up to and including, either sent off somewhere or even actually executed. And you could see that this replicated itself across the Soviet Union, including, as we've come to discover, the issues regarded to the famine, etc., in Ukraine. So that was all there. And, so yes, Lenin did, was concerned about this, but Stalin went a little bit further. And this is during the first 5-year plan. And now we have an opportunity to carry out a resolute offensive against the kulaks, so said Stalin, break the resistance, eliminate them as a class, and replace them with the production of kolkhozes and svovkolkhozes, whatever. That is, eliminating kulak households, and all kulaks assigned to one of 3 categories. Now, the point of this is to create collective farms to reorganize on a property basis, ownership of the agricultural means of production. And so this is also the rise of an enforcement mechanism, no different than the rise in the first Trump regime of the Customs and Border Patrol, which increased their numbers by multiple thousands. And of course, the Democrats caved or allowed themselves to actually propose a legislation that might actually, pass once the new Congress comes in, of yet another increase of power and personnel for the Border Patrol folks, who are, with all due respect, act like the local secret political police. So anyway, one category was to be shot or imprisoned, sent to Siberia, the North, the Urals, or Kazakhstan after confiscation of property. Those to be evicted from their houses and used in labor colonies within their own districts. So you can see that certain of these things are just right down the road, and uh, it's fairly clear, I would hope, that people can see that, this is not the only place, obviously, where concentrating populations, as in with the rise of National Socialism, the Nazis, operating in a similar way in terms to order um, the labor population for, the rising means of mainly modern means of production. So anyway, all of that occurred. Uh, um, all of these were about extracting natural resources and industrialization. This is what is being fought over in terms of Ukraine. The southern oblasts in Ukraine, of course, are more industrial. You know, Mariupol and its steel plant, for example, uh, and all of the coal mines and rare earth mining operations in in the Donbass. All of those they've been there for a century. Been developed. Uh, I mean, they mine all kinds of other things. Uh, Recall, of course, there was a salt mine that got fought over a year or so ago in the Donbass. Anyway, now, needless to say, Trotsky condemned the liquidation of the kulaks in 1930 as a monstrosity, urged the Politburo during the intra-party struggle to raise taxation on wealthier farmers and encourage farm laborers along with poor peasants to form collective farms on a voluntary basis with state resources allocated to agricultural machinery, tractors like we saw in that film Earth, fertilizers, credit, and agronomic assistance. And of course, certain other Stalinist things didn't help, Lysenko, etc. So, but the fact is, collective organization still functions, and actually probably pretty well. There are 15,000 farming cooperatives in Vietnam, and almost all farmers being members of some kind of cooperative. And the state also heavily encourages collective cooperation farming over private farming. But the business of sort of integrated public and private farming, that's kind of still there. The other kind is, of course, several varieties of production cooperatives in Cuba. And you have it resembles, with all due respect to Stalin, the difference between state farms and collective farms. And now, from a legal point of view, and this is probably the interesting thing about socialism, the law granted indefinite usufruct to the workers of the basic unit of cooperative production. In line with its goal of linking the workers to the land, it established material incentives for increased production by tying workers' earnings, the wage, to the overall production, and increased managerial autonomy and workers' participation in the management of the workplace. And that's kind of what has occurred in a slightly different way, but quite similar in the People's Republic of China. Even though, the market system, because of scale, is much better, and you don't have the kind of vertical problems that the Cuban economy as a client state in the Russian context has sort of been committed to. But needless to say, Cuba is better off than it was, I would assert, under Batista, but that's just me. And then, of course, there's something more recent, which is interesting, and we probably should spend a little more time on this, is a movement of U.S. voluntary collective farming started in 2008 in the Research Triangle under the name of the Crop Mob. The idea spread through the United States. Less than 10 years later, this particular type of incidental, spontaneous, social media-driven collective farming reported in over 70 places. Well, if it were in 70,000 places, I think we would be in a different way. Needless to say, as we watched the film Earth, if you will recall, the kulaks are the bad guys in the film, speaking of propaganda, and so that kind of occurs. Now, the other thing, which is also interesting, is the control of residency, which is not so under control these days. A the difference between the rural areas and the urban areas, and sort of the problematic role of, well, lack thereof, and that's highly controlled relative to the former sort of structure of things, as migration or even just sprawl. There is sprawl, but it's not the same kind of sprawl that you would see in a non-command economy. So, there's other kinds of responsibilities, organizational reforms that occur at various levels, and you have to think about, well, okay, how do they organize this? Well, there are regions and districts and sub-districts and a variety of other bureaucratic elements. But the fact is, there are social institutions that still do organize regionally. You have this kind of slightly larger than what used to be production units, certain larger units that they're not suburbanized by any means. They're still quite ruralized. And the difference between that and the big cities is fairly radical. And I mean, their version of sprawl is to build big, urban centers that they haven't quite figured out what to do with, and have, the ghost cities are a kind of an example of that. And it is an example of, well, you could say corruption, you could say bad planning, a whole variety of things. But at that scale, it gets lost in the process. The point being of all of this is what happens in not only initial cycles, but in subsequent cycles. And I would assert that you see that, yes, there's not much other than computers, office space, I suppose. That's the constant capital of financial capital. The variable, excuse me, the variable capital, of course, for the workers, the brokers and analysts. But that's a small proportion of the population compared to the kind of amount of capital that they're moving around. And so that's that disproportion, that inequality of capital resources itself. And if you treat it, in a sort of Chicago school sort of way, well, it's just human capital, and, well, maybe it has something to do with a whole bunch of other things in industrial capital, but we're not going to pay attention to that. Essentially, they don't pay attention to that. What they're working with is largely more abstract. Now, the fact is, they do represent a class, and I suppose, they could be all defenestrated, but that's not going to happen. The point is that these big things are there, and they have important roles, sometimes arbitrarily or capriciously put in place. So if you look at the history of the company that was almost completely wiped out in 9/11, Cantor Fitzgerald, you can see that by concentrating its efforts in electronic trading, they managed to rebuild it. Cantor Fitzgerald, and the head of Cantor Fitzgerald is now, what the hell is he? No, he's not Treasury Secretary. He's Secretary of Commerce, even though he annoyed Trump. So the point I wanted to make was that, it's still there. It's all working. If you look at Mandel's little chart here about the entire business of capitalism, you can see it operating here. And as I've mentioned before, we've been talking at various lengths about the commodity and how it evolves into the money form, how it becomes a money commodity. That is, it has a form, but then it becomes, within the context of exchange, it becomes a commodity and becomes built into a system of debtors and creditors. And that's kind of what is being worked with in the private equity market. And you see that, surplus value is being produced at a much larger scale, often in the abstract. And of course, you could argue that, well, it's just congealed labor, blah, 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 blah. Don't have to sort of worry about that. You have to look at it from a command point of view that, it, by being manipulated, buys and sells labor power. If it were within their power to kill kulaks, they do it. It's just not, not yet profitable. On the other hand, it is profitable at a certain level of investment. So I point you towards the considerable percentage in, I think it's what, 20% of one of the private prison companies is held by people like Jared Kushner, et cetera. And there are a couple of people who will be probably empowered by the shifts in Homeland Security, probably by this as well, when they start at least the mechanisms to, because I don't think that they're, they pointed out, and it's a kind of legitimation crisis that, well, you can't really, you know, deport 11 million people. Well, no, but you can achieve probably the same or even greater numbers than the last time people were deported in large numbers, and make a show of it. And, people will go, oh, well, gosh, all those lower class workers are being thrown out of the country, and we don't care, except for the fact that now food is expensive because there are fewer, restaurant workers or whatever. It's just no one's going to think about that. But that's where we're going to wind up again in a crisis. And so the point is, as I was pointing out in the last little episode, it's this move that you could see in the original diagram here. You can see that commodity money becomes universal money. So you're looking at a subsection of the big structure of the argument there. And you're looking at various things, measures of value, value and price. That's one of the issues that we cope with. But the other thing that is coped with as means of circulation is the issue of concrete money, that is not bricks, but palpable kinds of investment money in various locations. Maybe it's just the locations that have abstract issues, and then credit money as part of that. And the history of capitalism is about credits or credit, and of course debt, and the carrying of it through. And as I tried to point out earlier, that the simple Marxian equation is a system of circuits, and as Volume 2 and Volume 3 will talk about, and as I've tried to assert, they're kind of nested sets that, so that, circuits, the circuit of commodity capital and its relationship to productive capital is there. Their labor eventually does stuff, but it's part of a set of circuits that is connected to money capital, is what we were just looking at, and advanced capital, which which shows that this fourth area, that is advanced capital, is where you begin to see this sort of the carrying of the exchange issues that were being brought up in that Marx was thinking about. He's thinking about this, even in the Grundrisse. I just didn't have a way of talking about it. I think we have a better way of talking about it now. So I included in our little presentation here, it's 4 hours of stuff, and you can watch it at your leisure, I suppose. It's a 4 hours in 4 parts. This was done fairly recently, a couple of years ago, I guess. A frontline documentary on money, power, and Wall Street, which is worth your attention. I mean, it's not a Marxist analysis, but certainly does show some of the problems that we've been recently fiddling around with. Needless to say, doesn't quite get to where we were with FTX, et cetera, but sort of points in that direction. So that's that. Now, back to Michael Roberts, which just came out yesterday. This article came out yesterday, so it timely, or it's whatever. It's still worth something. It hasn't quite perished. So the point being is that Marx is often famously quoted from Capital that capital is dead labor, that vampire-like only lives by sucking living labor, and lives the more it sucks. So, and Engels also used that simile of the vampire property holding class. Pretty much the same. In 2019, remember Elizabeth Warren, in preparing for her presidential run, used the image to describe how the private equity firms are like vampires, bleeding the company dry and walking away enriched, even as the company succumbs. And that's sort of the general point of Robert's thing here, talking about, well, it is about acquiring capital, and then, it's, with all due respect, how pump and dump operates, or that, Robert's conclusion is no different than what we've talked about before. It's sort of a Ponzi scheme that, you keep doing stuff and you keep staying ahead of, when accountability occurs, and you can shift all of these things and use, as Michael Hudson has pointed out, the legal system. And as I was pointing out with Peace Store's Code of Capital, you use an entire network of superstructural elements. That is, international law firms, its overlap in personnel with the government and the Treasury, for example. And the current batch of folks who are up for head of Treasury, recall, of course, that the last head of Treasury used to be on the board of governors at one of the Federal Reserve branches, but that she also is a PhD economist. This is not probably what's going to happen in the next iteration. Recall, of course, that Steve Mnuchin was hardly a professional economist, but actually a lawyer, a investment banker. I guess you could call him. Needless to say, he's not exactly from the same cut from the same cloth. I'm surprised Mnuchin isn't back to skim even more money, but that's another deal. Partially, probably because we probably look at the kind of things that he created just after he left. He made quite a killing, I think. Anyway, private equity, the modern form of financial investment into and the management of companies and their workforces, is the epitome of this vampire motif. Private equity increasingly dominates the boards of small and large companies. Instead of investing in the shares of companies quoted on the stock exchanges and open to public sale and purchase, institutional investors, that is banks, insurance companies, and pension funds, etc., look to invest in private equity companies that in turn buy, manage, and sell companies. That's what Michael Hudson's talking about. The financial institutions expect to get better returns through private equity than through buying shares on quoted exchanges. And you recall, of course, that in Hudson's book, you could see the kind of manipulation of that kind of activity on a day-to-day basis. Quite interesting to see the kind of timeline for that. And the private equity companies claim they can deliver such better returns. And Robert's conclusion is that, no, it really doesn't. But it is certainly exciting. Well, more exciting, I suppose, than sort of leaving it to a stock market, as they say. So, as I pointed out at the beginning, this is how a private equity business model functions. It exists because of those little fees. Recall how Hudson talked about the fee structure, but also about carried interest, or things, carrying of interest that is at work as well. It sort of fixes in certain rates of return for certain periods. And this is the nesting thing that I was talking about before, that you get this, another kind of, well, you could call it churn. I'm not sure they call it churn, but you get things that look productive, and they're productive in the context at scale of capital investments. And you're not investing the whole, the whole nut in all of these things. And so you target companies, and then you move through them, and in terms of merging or restructuring or blah 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 blah, which is really no different than decades ago, but it's now got new names, and it is the function of private equity. And we saw the failures of it when certain elements of assets became toxic in this environment. Mainly because no one was paying attention, or maybe not so much paying attention as they were kind of moving too quickly for people to notice. And, well, we're not held accountable by the system itself. And of course, we're getting a new SEC chair as well with the Trump administration. So, whether you're going to get SEC enforcement or not, I'm going to doubt that you're going to get any SEC enforcement. I mean, the SEC does do enforcement, but I'm sure they're not going to be quite as rigorous. Private equity companies are just that. They're private. The private equity firm is set up by a usually small number of individuals, or in some cases as an offshoot of a larger financial organization, such as a bank, right? Chase Bank, for example. And then Bank of America, as um, Hudson was pointing out, and its peculiar failure. These private equity firms then launch one or more, private equity funds. They invest a relatively small amount of their own capital into the fund. That's kind of the deal, right? Typically less than 5% of the value of the fund. Then they look to raise capital. Investors, that is, who provide the remainder of the fund's capital, are attracted to commit their money by the promise of high returns. Now, this is no different than other, no one wants to call this a scam, but it's really structurally no different than the attraction of things like, well, Bitcoin or whatever. The investors usually agree to tie up the money for a set period of around 10 years. They pay the fund owners a management fee, often 1.5 to 2% a year, and they receive the earnings from the purchase target company on its resale and intermittently in the form of dividends and other payouts. Above a threshold rate of return, ROR, typically 8%, 20% of the earnings are retained by the private equity partners as so-called carried interest. And carried interest is one of those things that probably, darn socialism should probably take a little bit more advantage of. But anyway, of the money needed to buy targeted companies, only a proportion, normally between 20 and 50%, is provided by the private equity fund itself. Now, the rest is borrowed from banks using the assets of the companies as collateral for the loans. This means that the target companies must produce a stream of revenue out of profits with which to service these loans. Now, recall, of course, that if banks are involved, a lot of things get, as I referred to it a while back, it's about playing the float and, stuff happens. The private equity fund then runs the private companies with the eventual aim of a resale, that is exit, typically in 3 to 5 years. So the target companies must maximize the return to the new owners, that is the private equity fund, over the lifetime of the private equity ownership. So we're only looking, we're looking at relatively short-term profits, but, a decade is a decade is a decade. Eventually, the bought company is listed or relisted on the stock exchange, or a strategic buyer, normally a company in the same sector, or even another private equity fund takes over. Now, note, of course, that you could operate other things like, the market has all kinds of stuff in it. I'm not a market person, but you could see that in the history of the market, you have crazy crap going on, and like even in the election, you saw the up and down elements of the Trump Media Technology Group, or DJT, and it's moving around in terms of value, and a lot of people almost bailing out. But then I think somebody knew that the polling was going in favor of Trump, so things got fixed, sort of. So apart from the dividends and sweating the company for 3 years or so, a couple of people did bail out. It can be sold as a capital gain. In doing so, the private equity fund also charges the company consultancy and management fees for the sale. So, this is that transaction cost thing I've been talking about before, is that, that's where, if you're going to build wealth, you're going to build wealth from a variety of things all added up. And then you sort of go, oh, okay, made a lot of money. So this private equity model tries to maximize the surplus value out of company workforce, raises more debt to do so, and extracts the maximum return in dividend profits while reducing productive investment costs to the minimum. So they operate like capitalists. What is the impact of this vampire investment on workers and owners? One example, 70% of nursing homes in the U.S. are for profit. Recall that how COVID operated. Now, they are increasingly amalgamated into larger chains, often owned by private equity. The basic way nursing homes generate cash flow 2 out of every $3 it earns is through Medicaid. Now, note that killing Medicare and Medicaid or marginalizing it may be very profitable for some people at some moment, just because you have, churn of some kind. The company Manor Care, for example, had 25,000 beds and was the second largest nursing home chain in the country by 2017. In 2011, it was bought by the private equity firm, the Carlyle Group, recall them, sold the land on which the nursing home sat to a company that specializes in being a landlord to healthcare providers. You can see how this overlaps with an entire parallel industry. Previously to this, the nursing homes typically owned their land. Carlyle profited the proceeds from that land sale, paying off the debt that it had incurred to acquire Manor Care in the first place. So Manor Care then had to pay rent. Remember, we've been thinking about rent, how rent works in an advanced capitalist economy, using its Medicaid revenues while Carlyle took the profits. But with this new rent burden, Manor Care's margins contracted. Carlyle then insisted on cutting labor and wages. Note, of course, that I think that COVID made us realize that, healthcare workers, it's a gig economy. And in fact, the spread of COVID occurred because of these healthcare workers moving from, nursing home to nursing home and in their gigs and actually helping the spread when we didn't sort of know what was going on. The quality of care in the homes went into a downward spiral. Lawsuits from relatives spiraled, and eventually Manor Care went bust in 2018. Private equity has been a bonanza for the private equity fund owners. As the founder of one large sum fund put it when he started, I looked at the capital structure and realized the returns that could be achieved. I said to myself, this is a gold mine. Ever since, the promise of eye-watering returns has enticed pension plans, endowments, insurance companies, private banks, and business tycoons to invest in private equity funds. Today, private equity giants such as Apollo Global Management, Blackstone, and the Carlyle Group control about $8 trillion in assets. Now, that's quadruple what these firms oversaw in 2012. There are at least 18,000 private funds in the U.S., most investing in middle and lower middle market companies. That figure grew by more than 50% in the last 5 years. Private equity assets globally have now reached 13 trillion, according to consultants. Remember McKinsey, and Pete Buttigieg worked for McKinsey, recall. So we live in private equity times. You can see the rapid growth from the turn of the century. Institutional investors expect to get a better return on their money from private equity than from the stock market. CEM Benchmarking, a Canadian firm that collects data reported by $15 trillion worth of pension funds, endowments, and other sovereign wealth funds, found that the average annual net return of private equity was 4% points higher than on public equities over the last decade. So you can see the annualized return for Cambridge Associates Private Equity Index over various time periods. This relative gain is disputed by other research. Ludovic Filippo recently published a paper that reckons the returns are no better than the quoted Marlett. The report shows that the median private equity firm earns just over 1.6 times investors' money over 4 to 6 years, which is comparable to the long-term returns of U.S. stocks. He found that in recent years, private equity funds offer their investors just about the same return as could be made putting money into broad stock market indices. But recall Feldo's comments on index funds, with much higher costs, which he figures to come to about 7% points of gross return in both management and performance fees. And that number does not include the extra monitoring and transaction fees sometimes charged to companies owned by private equity funds investors. Filippo reckons that the only people to do well out of investment in private equity funds are the private equity tycoons themselves. That is money for nothing. In addition, the largest private equity firms in the world have avoided paying income taxes on more than $1 trillion of incentive fees since 2000 alone by making payments in a structure that subjects them to a much lower tax. Senior employees of private equity advisory firms earn salaries that are subject to standard income tax, the report states, but they also receive payments conditional on the performance of the funds they advise. That is the carried interest. And you can see that Hudson talked about that. And carried interest refers to the share profits made by private equity fund managers from an investment deal they put together. It's taxed at the capital gains tax rate instead of at the income tax rate, which generally means private equity owners paying 28% tax instead of 45% tax. It's a stark difference from how publicly traded firms operate. It shows you the upper bound of what governments could collect if all the countries in the world coordinated to tax that pot. Filippo said in an interview, adding, once you understand how much money we're talking about, you can understand why private equity is the largest donor to politicians and universities. In the UK, about 3,140 private equity professionals shared £3.7 billion worth of carried interest payouts in 2023, according to data gathered by the University of Warwick. The new UK finance minister, Rachel Reeves herself, before she took office, said that instead of hitting working people and businesses with tax rises, we should be spreading the burden and creating a fairer system. It's absurd that the current regime around carried interest means tax breaks for fund managers averaging £170,000 per person. It's not right that working people and ordinary businesses have been hit by a jobs tax, while private equity fund managers don't have to pay a penny more on their income and are in fact handed a tax break by this government. So they asset strip some of our most valued businesses. Recall that asset stripping was really important in the context of Michael Hudson's book. Since taking office, she no longer refers to private equity funds as asset strippers, and it's no longer implementing higher taxes on the funds. Oh, yeah. And some private equity companies do not deliver better returns over time than investing in the stock market. Nominal returns may appear greater, but only because of huge debt buildup by the funds. The model works like this with one large private equity fund, KKR. In one purchase of a company at $380 million, KKR put in just $1 million, the rest being borrowed by the company itself to pay for its own takeover. The return is measured against the $1 million plus interest on the loan of $380 million, not on the total loan. And Hudson mentions that in one of the chapters. Then there are the ongoing costs of the investors. Private equity typically charges a 2% annual management fee based on investors' money committed to the fund, along with a 20% share of the profits over a pre-agreed returns threshold of typically 8%. There's a huge drag on performance relative to fractional percentage costs of investing in passively managed quoted equity. Another recent paper by Richard Ennis concluded there was no support for the proposition that private equity has added value to pension funds' return in the great financial crisis, the post-great financial crisis era. Despite private equity insisting that they improve companies, Bain's, you recall Bain, right, of Mitt Romney, Bain's latest report on the industry estimates that nearly all the value creation in private equity-owned companies between 2012 and 2022 actually came from revenue growth and multiple expansion. Margin expansion hardly registers, the consultancy noted dryly. This means that private equity takeovers did not lead to any appreciable improvement in profitability through better investment and management, but only by squeezing the workforce, leveraging up debt, and then selling on. The most comprehensive study to date commissioned by the World Economic Forum, those people in Davos, right, who get protested every year in Davos, Switzerland. It found that PE activity, private equity activity, results in larger employment losses than in control groups that adjust for factors such as enterprise and size and sector. The companies that private equity takes over are traded quickly and are usually run for maximum short-term profit. This can mean slicing off many of the elements that make a business robust for workers and customers: a solid pension fund, a host of buildings owned debt-free, generous terms for employees, and enough staff to ensure good customer experience. One study by the universities of Harvard and Chicago showed that on average, during the first 2 years of owning a company, private equity managers cut 1 in 7 staff, reduced wages, and raised prices in a process financiers call margin expansion. Now, Liz Warren says Washington has looked the other way while private equity firms take over companies, load them up with debt, strip them of their wealth, and walk away scot-free, leaving workers, consumers, and whole communities to pick up the pieces. Workers lose out, investors make little gain. Only the private equity companies suck up more. Hedge fund tycoon Cooperman concludes that private equity funds are increasingly a Ponzi scheme. What you see is that the vast majority of deals currently are being done between private equity firms. One private equity firm will sell to another who is happy to pay a high price as long as they attract a lot of investors. Hudson talks about this. The bulk of deals are like this. I think private equity is a scam. They're getting very fancy fees for sitting on your money. Yet, the private equity vampires remain ubiquitous and gorging on yet more surplus value blood. Private equity group Blackstone, right? Blackstone is in Ukraine, among other places, now has over $1 trillion of assets under management and employs about 500,000 people around the world. Of the top 20 equity companies, 17 are from the U.S., and there's this huge list here, which, some we just, we don't know about, haven't heard of. Some we have, Fortress, Silver Lake, Goldman Sachs, Apollo, Advent, Warburg Pincus, Bain, Carlyle, etc. The boom in private markets since the 2007-2009 financial crisis has been huge, mainly relying on the very low interest rates to rack up debt on the companies purchased. It helps that the government buys the toxic stuff, right? After central banks around the world slashed interest rates to near zero in response to the financial crisis, private equity embarked on its longest and most powerful boom. In 2021, the market's zenith, a record $1.2 trillion in deals were struck, according to PitchBook data. Economic slumps provide fresh bloods for these vampires as small companies struggle in recessions. In the 2008-9 slump and the pandemic slump, private equity firms announced approaches to more than twice as many listed companies as they've ever done previously. And private equity company Bain Capital's managing partner, John Connaughton, commented, "One of the most productive periods for us was right after the global financial crisis." Who knew? But now a series of rapid interest rate rises since 2022 has dried up much of the fresh blood that vampire private equity funds need, and many private equity-backed companies are saddled with large debts and face much higher interest costs. Default rates are picking up, and lenders are increasingly taking control of creditor companies at the expense of the equity owners. And you can see the kind of churn that's going on here, the volatility. In recent months, KKR, Bain Capital, Carlyle, and Goldman Sachs have lost control of several businesses that they backed. Brian Payne, an analyst of private equity deals at BCA Research, says the risk of capital loss is higher than it's ever been. Even when you go back to 2007 or 2008 vintages, the longer the higher rate environment persists, the higher the risk of capital loss. And so the growth has chilled amidst higher interest rates. And you can see their interest in having someone who's going to help prop that up by tax cuts, etc. Private equity drawdown vehicles usually have 7 to 10-year lives. So the consequences could play out over several years as funds struggle to raise successor funds if unable to persuade their existing investors to pony up again. Less money raised will lead to lower fee income. Some funds may just decide to throw in the towel and wind down. In the meantime, private equity vampires have infected whole swaths of companies with debt. A recent Gartner survey found that 24% of small cap and mid cap businesses have far greater debts than their earnings before the EBITDA, earnings before interest, taxes, depreciation, and amortization. 37% of small cap, mid cap, and large cap companies say that interest payments account for now more than 1/5 of their cash flow. Furthermore, the number of companies that admit missing debt payments surged by 80% from 2022 to 2023. Over the last 2 decades, the vampires of private equity have gorged themselves in the profits of labor and the companies they've sweated while avoiding sharing those profits with their investors or with governments through taxation. They engage in various forms of financial engineering to increase their gains. And in doing so, they have leveraged key sectors of the economy into huge debt at the expense of productive investment. Now, rising debt servicing costs, this is why inflation is going to be this big thing coming up, adding to the risk of a major financial crash, acting as a stake through the heart of many of these vampires. And that's that. Not a happy ending, and it's still we're still in the midst of this, and Trump and his cronies have not yet taken over at least one tiller of the financial machine, and we're going to see, because of the cronyism, how screwed up it's going to be. And if you remember anything from the Trump era before COVID, there was all kinds of monkey business going on, shenanigans of all sorts, and Trump is he's just a spokesmodel. He just goes out, oh, well, we've had this industry consultancy and we've had this meeting in the White House and blah, blah, blah. I can't remember how many of those stupid events he had, but they were absurd. They, showed him sucking up to major areas of capital. He promised, well, we have, all these new blah, 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 blah. And meanwhile, companies were being shut down. Stuff was being outsourced still, amid all the rhetoric of, well, we should buy American and blah, blah, blah. We're going to, tariff them to death and blah, 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 whatever. Anyway, enough of that. Thank you for your attention. No new brickbats. There's the potential of a slump because you've got clowns running the clown car, and too many clowns, and we'll see how that works out.
Some people I was questioning slump it was more 2000. It said the 2008 slump, and I was like, that was more than a slump.
Oh, indeed. People have short memories. So another slump might come again, right?
Yeah. In that one diagram, what is let's see, GP and LP, I think it was.
General partners and limited partners.
Oh, okay.
It's about risk, how the business model functions. That's why, this institutional investors are limited partners and stuff over there, I guess. It's not like I play with this amount of money.
Yeah.
I went to school with a whole bunch of people, got very rich doing this kind of palaver, but it's not that I would have given anything to work in Silicon Valley. Anyway, okay, so not hearing any other interventions, etc. I urge you to read this. This just came out yesterday, so I it's very timely. It's very timely in terms of the data and opinion, and of course written by a Marxist, but he's upfront about what's happening here, and
I had a question.
Go ahead.
If you can hear me okay?
Yeah.
Forgive my ignorance of the subject and my having never seen The Apprentice, but I get the feeling that Trump may not understand all of the aspects of running businesses.
What makes you say that? The 6 bankruptcies?
I'm seeing away with it.
I mean, how can a guy bankrupt a casino? I mean, it's just that little idea alone.
Don't bet on the red. Don't bet on the red. Never bet on the Reds. Dirty Reds.
Oh man!
But it is all about debt. It's all about
leveraging
and using debt to your advantage, and having access to enough capital to be able take on that debt. And then, yeah, this idea of then stripping these companies and then selling them off, and then, you know, Toys R Us and all these other companies that basically got that treatment, but they have to be in a distressed. And basically, I was thinking, why would anybody sell to a private equity company? Well, because you're in distress and you need to sell, right? I mean,
Yeah. Well, you know, you got to pay for that second Lamborghini or something. I don't know. That second,
Right.
third, fourth home, whatever.
and you don't really care about the people who are actually working for you. That's
Oh, no. No.
they're disposable. Especially in times where the economy ain't so great and there's not a lot of jobs, you can just, yeah, if you don't like it, we'll get somebody else. And if you don't like how little we're paying you, find somebody else. We'll find somebody else.
Indeed. And, you know, it just continues unabated with all due respect. You know.
I know. I mean, Elizabeth Warren talks about how we look the other way. What kind of, I'm imagining a fantasy world that won't exist probably in my lifetime, but what kind of legislation would it be that would make all of this illegal?
Well,
Something like
giving,
carried interest, right?
yeah. And showing that had an effect on consumers, which is what the Warren, you know, agency or whatever entity tried to do
Consumer.
before she
Yeah.
became a senator. You know, these are fraught times. Although, you know, frankly, not enough is you know, American oligarchs aren't quite as ruthless as, for example, Russian oligarchs. And it would seem to me a couple of more not middle managers cashing their chips in, but you know, more extreme measures could happen. Should happen.
I was gonna say we'll see where we are after the next 2 to 3 years. They might become as ruthless.
Well, you know, I mean, well, anyway.
So, especially if they're not punished for it or in any way regulated.
Well, this is
Why
that
not?
mob thing again. Yeah.
And as
Mob
long
in
as
both
Trump gets his
instances.
cut, yeah.
A mob in terms of organized crime, and then there's just a mob.
Right.
And it's just unfortunate, you know. We're not going to keep rerunning the 2024 election over and over again. But now we see, now that the numbers are being counted, how close an election it was, and that the margin of victory was fairly
I know.
fairly tiny.
Well, and people and I keep hearing this on all the left-wing podcasts. Well, it wasn't a mandate. You can't possibly declare it a mandate. I'm like, you
Except that he
so
does.
don't remember. And I was going to say, people don't remember 2000 and Bush.
Right.
And that's exactly what he did. And it worked. Yeah, I won. I have a mandate. I forgot the term. Bush had a term, you know, about the will, you know, something about the people, bullshit. But I mean, you declare it a mandate and you keep saying it, and it will be a mandate. And then you have the news media saying,
then you have a war, you know.
well,
Then you have a
and
crisis or whatever, you know, because that's, I mean, how cynical do you have to be to try and keep people on their cruise ships because the numbers are too, infection numbers are too high?
I hear that train a coming.
hear that train a coming.
Well,
Yeah, I don't know if it'll be another. I know what do people think the crisis will be in the next 2 years?
Or
I don't know.
mandates.
The next bird flu can't be that bad. Let me shut off the
All right.
live